Good evening, good afternoon, everyone. Thank you for joining us for another monthly call. If this is the first time you're joining our team for our monthly webinar, we are a community of professionals at Factum that teach financial management, life insurance strategies in the infinite banking concept, and we offer education through our entire community on a consistent basis for all of us to continue to progress in our journey and our relationship with this beautiful asset we call whole life and life insurance. Today, we're going to have a very fascinating conversation. I think it's one of probably most popular topics, which is the idea of the use and the nature of policy loans. So we're going to have a set of conversations. We're going to talk about what they are, the general mechanics, and we're going to see maybe some ideas around how to manage them properly and your options when it comes to managing those policy loans. So we're going to jump here into our content. You likely saw when you register the theme for today, like I said, the loan you control, why whole life policy loans work differently. And the theme that I want you to think about this as we go into the conversation is perhaps not all debt is created equal, and not all the environments we use to source debt offer the same type of control and the same terms. You can imagine here that our hypothesis is that policy loans from a life insurance policy are unique and they are very special, and that we need to start to frame them in our mind as a very useful and powerful tool we have under our control as policy owners. So, as always, Kyle Wade, everything we do starts and ends with this idea, the 5 areas. Again, if you're new to our community, one of our more fundamental beliefs is that the perfect life looks like having abundance in the key areas of our life for us, spiritually, personally, family, financially, and occupation. We are having a conversation today in the financial area of our life only with the pursuit of being able to create more abundance so we can fund more abundance in every single other part of our lives, including all the things you guys are grateful for and that you share at the beginning of this call. So we are very grateful to have the opportunity to bring that value to all of you today. Kyle, wait, what if we start the conversation with an important question? And I'd like to invite everyone on the call to participate in the chat or unmute yourself. By the way, if your camera is off and you love to be more an active participant of this conversation, I invite you to turn your camera on. We'd love to see you. We'd love to welcome you, and thank you for being part of our community. So when it comes to debt strategy, the first question that I would like to ask you is the following. When you need to borrow money, where do you source your debt from? Where do you source debt? What are the options you typically think about when you need to access debt, when you need to borrow somebody else's savings? Throw it in the chat, unmute yourself. No wrong answer, just curious. What is the sea of options that we all have in terms of access to debt in our economy? So Jeff says, lines of credit, bank loans, credit cards, great options.
Mom.
Kyle Fuller says, my policies. Thank God somebody said that from our team immediately, policies. Otherwise, we would be in the wrong call. A bank, mom and dad. I love that answer, Brian. Absolutely. Absolutely. I thought that was my son for a second, but that was Brian.
That was my son.
Yeah, it's looking for my boys too.
CSB. Am I missing this? What is CSB? Sorry. It may be self-evident, but I'm not sure what you mean by that, Tom. If you want to expand your comment. Bank loans, family members, policy loans, policy banks, HELOC. Cash surrender value. Perfect. Thank you, Tom. That's very helpful. Any other thoughts there, Wade? Kyle?
You got a HELOC on there.
Love it.
Another thing we kind of forget is where do we source our debt? Sometimes it's cash.
Interesting, right? Sometimes using cash can be a form of, if you're applying banking principles, a form of debt generated with that collateral, correct?
Correct.
Okay. So cash surrender value, perfect. I'm going to take it a step further. Now that you've seen several options most of us have access to, the question becomes then, how clear and confident am I on my debt criteria when I do the selection process of where I source that debt? What is my criteria to say this A option is better than option B or C? How confident and clear am I about that criteria?
Yeah, and I would have you think about this. It's always on a spectrum, right? It's not either one or the other. But one being like I have no idea. I just go, whatever pops up in my email today, versus 10. I'm very clear, very confident, and have a plan, and everything is all lined up before I go after my debt.
Mhm. Yeah,
So, and again, this is for you to kind of think about, like, how clear are you in that process? Because this is going to be that's going to be really helpful for you when you start putting together why am I borrowing money and for what reason and where am I going to access those dollars? So that's really for the reason for the questions. Like you being clear and confident about the process is going to be highly beneficial to you because then you're going to know where you're headed versus think and be in the thinking game.
absolutely. So, Kyle, if someone in the call happens to not be confident or clear about that criteria, I think one of the places we can start is maybe giving them some frameworks to think about that, not right or wrong. We're not suggesting here that is bad or good, or any environment being better than the other, although you can imagine that our bias completely is going to be towards policy loans from a properly designed whole life insurance policy. I don't have to hide from that. That is going to be our truth. And if you are educated enough, you'll likely come around to see why we say that. But what if we start with a framework or where debt is sourced from when we look at our financial statement? Would that be helpful, Kyle? Do you
Let's
think?
do it.
Okay, let's start putting some form to this. So in the screen, if you've been around our education, you recognize this image. And if you're new, I cannot insist. Please reach out to the person that invited you to this seminar and ask them for the path of money education. What you see in front of you, just as a recap, is the idea that we all have a financial statement divided in two key pieces. An income statement, money comes in and out. Typically, income comes in and we spend or donate some of the money. And at the bottom, we have a balance sheet, which is how or where we control and own assets. And I'm going to propose an idea. Debt likely is sourced, and collateralized two ways. We either are going to borrow money with the idea that we're going to pay it in the future against our future income. So we're going to prove our credit worthiness and we're going to look at our credit score. And some third party is going to say, absolutely, Mr. Zapata, you can borrow $100,000. You're going to have the following terms and you'll be able to make those the repayments with your future income. All of us probably have used a credit card, a car loan, although that's collateralized against an asset, but things that are collateralized against our credit worthiness based on our future income or projected income. The second part of this is looking at the bottom. How can we borrow against the things that we own and control? A HELOC, a margin loan on a brokerage account, a loan from a 401k or from another asset, right? So I would say the first bucket I look at this is what am I borrowing against as collateral? Would that be a framework you agree with, Wade?
Yeah, I mean, what else could it be? I mean, maybe you, David, you could borrow against your good looks, but it's either your income or your assets, right? So
That's called an unsecured Colombian loan, my friend. Yes, right. And so since you propose that there's no other options, I'm going to add a piece here from the path of money. Once you look at your balance sheet, not as a mumbo jumbo of assets, but maybe there's a couple of distinctions. We have safe, liquid, foundational assets in green, like you all know about our framework here in the path of money, and then investments, acceleration assets that have the opportunity to have upside, but perhaps some risk. I would say that not all borrowing against your balance sheet assets is equal because the foundational assets may have certain characteristics that make the terms of the loan different than borrowing against investments. As a matter of fact, I'm going to put this in front of you and I'll throw it back to Kyle here. But the last thing I want to show you is this. This same path of money, if you draw it to proportion and you use a family that is earning the top 10% income in the country, $150,000, this family is winning in America. $150,000 in income. They have a significant balance sheet, $800,000 or more typically. A lot of investments. Typically, their investments are located in the equity in their primary residence, some retirement accounts, some brokerage accounts. They will have a certain amount of liquidity that tends to be around 5% across the country, by the way. Okay. This individual will look at their ability to borrow against their assets or their income and will only think of lines of credit against income or investments. but rarely will think about borrowing against their liquidity because it's so small and not as significant and relevant as it should be. And that changes the way they think about the nature of loans, the source of where they get that debt from, and the control over the terms that they can secure on their access to debt. Any thoughts on that, Kyle Wade?
No, I think having the path of money framework overlaid over this is very important. We're starting kind of high level here just to get people orientated to how does money move through our life and where do we usually bring in this third party institution if we're going to come, if we want to borrow money, we're going to use our income or we're going to borrow against another investment. But rarely are we looking at this green category, the liquidity category, and this is where we're going to have our life insurance conversation tonight. And I think a lot of you are going to be really excited after we're done with this call on a whole new world of options, flexibility, freedom, and control when it comes to borrowing against these policies. I also think too, David, this is probably one of the benefits of whole life insurance that gets misconstrued and misunderstood more online than just about any other benefit of life insurance. I think because there's so much freedom with what we're about to talk about, I think people tend to market this as this like magical type of thing, and it's really not. If you just understand the mechanics, I think you'll come to the conclusion that this is a powerful place to be leveraging.
Yeah.
But it's not magical. But unfortunately, online, we've heard so many wild claims about policy loans, and we're going to debunk most of them tonight so that we are just better educated, because we definitely want to bring some truth to this conversation.
Great. So why don't we start now that we are oriented to like maybe how it contrasts with our financial statement? Let's do a comparison on how most people think about debt from a third party and what it looks like mechanics wise from a policy loan way. So
Yeah.
The first thing we're going to do is set the following observation, not right or wrong, okay? People tend to have a limited view of debt, particularly when we look at consumer debt. And I think the comparison comes here as debt is bad or good based on the interest rate we paid on this debt weight. So this is part of our debt strategy from our Tough Money curriculum. If you're not familiar with that, highly encourage to get access to it. And we use this example to give people the idea that not all debt is created equal. Typically, the conversation with someone that is involved with consumer debt is, let's look at the spectrum of interest rate. Well, my primary mortgage rate is amazing. It's 2.99. I never want to let go of this mortgage because it's fantastic. It's great debt. And my student loans may be at 5%. My auto loans may be at 8%. And eventually I have credit cards at 30. And if I were to make a comparison between the different levels of debt or the different places where I have consumer debt, the extent of my analysis is going to be 30 is worse than 10 is worse than 5. End of the conversation, right? And what we want to bring to all of you is that, yes, that is a very strong indicator for how we prioritize, particularly consumer debt, what we go after to alleviate the pressure that puts in our financial statement. But what if there is more to this conversation in terms of the control we can have over the terms of the debt? And that's going to be the basis we use to make the comparison to why policy loans, although at, let's say, 5%, 6%, they offer much more value beyond what an interest rate can tell us. Fair? Okay. So, Kyle, wait. We in the last call, by the way, in April, and actually we have been bringing this around. We've talked about the idea of banking, and we've talked about the fact that we play multiple roles in the economy. Saver, we store money at the banks. Borrower, we borrow money from the bank, and we always propose the idea: what if I'm the banker, right? All these three parties need access to places to store capital and need access to liquidity. Right? We're going to come back to that once we do a dashboard with Kyle here, where he's going to share some of the mechanics and options for loan repayments. This is going to be an important idea because if we establish that not all debt is created equal and that terms and control are important, it is likely that this person in the middle, this entity in the middle, banker, is the one exercising how the rules are written for this type of creating debt or accessing liquidity through debt. And it would be another argument that we bring to you of why all of us need to consider how we become our own bankers. Okay. This is all context. We're just setting the table here to have a deep conversation about this. The last thing, and then I'll throw it back to Kyle so we can talk about some options. One last comparison. If you've seen our monthly education this year, you've seen this theme of the interaction in our balance sheet between foundational assets and acceleration assets. So typically, when we talk about debt, okay, we are going to go to a third-party bank and we're going to access credit, like we said, against our income or against our assets. If we need $10,000 and we're going to go buy a cash flow producing asset, right? The expectation is that we borrow that money and that money better come back with friends, and we're going to incur an interest cost. We're going to pay the $10,000 we borrow plus an amount of interest, and our profit better be greater than that amount of interest for us to have a profitable endeavor. That's the extent of this conversation when it comes to loan mechanics, regardless of what bank we're using, third party, right? What we're suggesting here is nothing more than introducing a better foundational asset to control and take advantage of that interest cost that we're talking about, Wade. So
Yeah.
do you want to walk through this mechanics?
Yeah. So, if you think about it, every paycheck you probably ever received in your life flows into somebody else's banking account or somebody else's bank. It's your account, but it has somebody else's bank on it, and they make money off of it. I mean, that's just the way it works. We're not communists. They don't do it for free. So you put your money in there and they're going to make some money off of it. The secret is that they understand how money works and how money flows. So they're more than willing and excited to have you put your money in your bank. And then along that same lines, and they turn around and they lend the money back out. So money's constantly flowing back to those institutions like Wells Fargo, Chase, and so on and so forth. What we're proposing here is, and everybody kind of knows this because we're obviously talking about this, is that you take that money from your bank, from your checking account, and you move it inside your whole life policy. Why do we do that? It's a better environment. It has all these 8 benefits. And it's this idea of we're going to create our own wealth, be the wealth creator. And we're going to do that with a mutually owned insurance company because they're ran for the benefit of their policyholders, you and me and everybody on the call. So that's really what we're looking at here, is that the money is going to be flowing from our segregated account into the bank into our whole life policy. Now, next step, David, would be, what if we need dollars? Because we have an opportunity to say, hey, we have an opportunity to go buy some cash, the CF real estate, the cash flowing real estate, or we want to acquire a business, or we want to make a personal loan to somebody else, whatever it might be. It doesn't matter. We go to our mutual insurance company and we say, hey, we need $10,000. Now, they don't ask you what it's for. They just said, sure. They look in your policy. They dump the money into your segregated account. They put a lien against your policy. And then again, now you have $10,000 in your control. Well, the same $10,000 is still inside your policy, earning interest, earning dividends, growing, giving all these 8 benefits while we use those dollars. And we just use it as collateral to borrow from the mutual insurance company. Because you have to realize these mutual insurance companies have a ton of money. I'm going to say a ton of money being a lot, right? They have, if you look at where money sits in this country, a lot of it sits in mutual insurance companies. So why not have access to their best dollars, their free dollars, be the first in line to have access to those dollars? So then we can go out and then we can use the money, buy a piece of real estate, for example, and then when that real estate, we purchase it with a down payment, and then it would be paid back because we have a plan for that piece of real estate to pay our I call it the Borth Family Bank. The Borth Family Banks can get paid back by that piece of real estate because I lend it $10,000. The expectation is that money's going to flow back into my bank because my banking business has to be just as profitable as my real estate business. So let me say that one more time again. My banking business should be at least as profitable. It's way more profitable because it's way less noisy than any other business I have, but it should be at least as profitable as my real estate business, acquisitions, or private loan I'm making to other people. So I expect that $10,000 to come back plus a reasonable rate of interest.
Yeah. And once it comes back, Wade, the idea is that we have a plan to repay the life insurance company and remove that lien on the collateral we have, which is cash values, which allows us to, again, replenish our available cash value. And with the additional cash flow, hopefully with the profits, we're going to continue to grow the system by paying additional premium.
And that's where the compounding really starts, David. And so that additional interest that we maybe charged, Bob, our neighbor, because he wanted to buy an RV or something like that. So we borrowed him some money, some short-term money. Somebody wanted to buy some real estate, so we did a short-term loan, 15-20%, which is pretty reasonable in today's marketplace. What do we do with that extra interest that was above and beyond what we paid the insurance company? That goes back from our policies in the form of the paid up additions.
Yeah, the spread. The only problem is that we can only do once per policy in our lifetime. So then once you do it once, you're done, right?
Yeah, pretty much. You get one shot. No, we're just kidding.
So
The nice part is you might have a money sitting inside your segregated account, your checking account. Now, again, it doesn't have to be anything fancy, by the way. It can just be checking account number 2 at your credit union, wherever you bank at. And the money can sit there and you say, well, I got 3 deals coming down the pipe. So I borrow money from the insurance company, I put it in there, I buy the piece of real estate or I do a private loan. The money comes back, principal and interest, and I just let it sit there and then do it again and do it again. And again, you're the one that's in charge of that business, of that bank, as it were. And that's where Nelson was talking about having it's not Wells Fargo as far as a bank, but just that the banking process. But you're the one that's in charge of that flow of money. And that's where the real gain of this starts to happen. That's where the real growth and the compounding starts to happen. You lend out $10,000, $12,000 comes back, and then you lend out another $10,000, $12,000 comes back, you lend out another $10,000, $12,000 come back. You only lend out $10,000, but 3 different times, but you get $6,000 in return. Now, what do you do with those extra dollars? That's the paid up addition you put back in your policy, and that's how compounding and wealth creation starts to happen.
yeah. So again, if you're new to our community, you may have never heard this conversation, and we walk really quickly through this. I promise you, there's a ton of education we have in our courses for you to come up to speed. But this is the level of conversation our clients likely will have based on the education. Again, we're constantly providing them for them to understand the loan mechanics is a function of the relationship we have with a mutual insurance company and our ability to collateralize the value that is constantly growing inside our portfolio of policies. All of this is possible, and Kyle, I want to hear your thoughts. These mechanics are possible because we're looking at the benefits of the product we're talking about to perform this banking function, which is whole life insurance. Particularly, we're talking about the flexible loan provision. But Kyle, what are your thoughts? Why are we reviewing this, and why do we continue to revisit this idea of the mechanics to explain where this is all coming from and why sourcing debt from our life insurance policies may be different than any other type of debt sourcing?
Yeah, if you look at that benefit there on the left, David, we have in gold the words ultimate control. I think the more you understand about this benefit, it gives you such unique advantages in the money game. I mean, there is no other financial product or tool out there that gives you this type of control and flexibility when it comes to private financing. And it's why we'd say whole life is one of the strongest banking tools you can ever purchase. And so having the option for basically a guaranteed line of credit via an unstructured loan gives you that ultimate control. And so I think starting with some of the foundations on just setting this conversation up properly, this will eliminate a lot of the noise you're probably going to see online. Like I was saying earlier, the loan provision is probably one of the most misunderstood benefits that exist. And to be very clear, what David and Wade were just talking about, when you take policy loans, this does not increase the efficiency of your policy growth. We hear that online all the time. Start a policy, lend against it, max loans immediately. It's going to grow with or without a loan, so you're better off taking loans. This is where you have to have the banker's mindset. If you're going to take policy loans, you have to have a proper criteria on what you're going to be lending for, so that additional capital flows back into your system, which is the entire process of banking if we had to simplify it to like one sentence. Money comes out, more money comes back in. That is part of the only thing that banks do, and they're some of the wealthiest companies in the world. And so we need to treat our system the exact same way. So just because you took a policy loan does not mean your policy is becoming more effective. It only becomes more effective when more premium is added to the equation. So I wonder if we should jump over to the whiteboard real quick, David.
Let's do it.
Kind of run through a case study, if you will. And let's set this up because you guys just did a great job talking through a lot of different elements. You've got your income here in your life, and we're all making money actively, passively. This money is going to flow into some type of commercial bank. I mean, this is how all of us are operating. And from that bank, we probably have a few different accounts. We might have the personal account number one. Maybe we leave around $15,000 in this, and this account is used for expenses, vacations, groceries, gas, vehicles, everything that you're spending money on, right? And then a portion of our income is going to go into maybe an account number two. We'll call that your high yield savings account. This is like kind of your emergency fund. It's for jumping on opportunities in the future. A lot of people have this savings account here. And all that we've done thus far in this financial journey is we start taking some of this money in the savings and we direct it over into a policy in the form of premium. So we're just moving our savings from this location to the next location because I want those 8 benefits. I want the guarantees, I want the privacy, and I want the access for that loan provision. Now, as I'm accumulating cash value, and every single one of you on the call is currently doing this, and you're going to see your cash values constantly increase. That's one of the benefits. Regardless of what's happening in the stock market, this policy is always growing. Now, here's a very important distinction. When you have an opportunity, let's say down here in the bottom right, let's say you have a piece of real estate you're going to buy, and there's a great return on this deal. And you say, you know what, instead of using my own cash, I'm going to call up the insurance company and I'm going to access this policy loan. And this money comes from the insurance company. It does not come from the policy. You're going to hear this one online. Why would I borrow and use my own money, pay back interest to my own money? You're not using your own money. You are calling up the insurance company saying, hey, I want a $25,000 loan. They look at your policy. Mr. David Zapata's got 100 grand in there. Of course, we'll lend him 25,000. It comes from the insurance carrier. Now, here's where you can be really effective with making your life so easy going forward when you start using policy loans. Instead of sending that policy loan to your personal checking account or a savings account, you want to send this loan to this separate or segregated account David and Wade were just talking about. So this literally is a separate bank account you're going to go create. The sole purpose of this in my financial life is to take in policy loans and loan repayments. So this will keep your accounting so easy, because let me tell you what's going to happen. When you start buying more assets, becoming more wealthy, 5, 6, 7, 9 months go by, and then your CPA is asking you at the end of the year, what was this deposit for $25,000 back in February? And you're like, ooh, yeah, was that income? Was that a bonus? You will not remember these things with all the things that are going on in your financial world. So if I have an account and all it is money that comes from the insurance company, and then if I'm using this to pay off debt or make an investment, the same payments are going to be directed back to that separate account. This will just make your whole life so simple. And then from there, you have several options. Are you going to start paying back the insurance company on a regular basis? Are we going to wait a year? And so before we move on to some of the different options for policy loans, I want to just make sure that anyone has a chance to ask a question if something on here did not make sense to you. This is the perfect time to ask questions about the actual implementation of infinite banking. So maybe we'll give it just a second, and you can raise your hand, you can unmute yourself, you can throw it in the chat. But all we're doing is setting up a separate bank account, and its sole purpose is just to handle the monies from the carrier and coming back from loan repayments. Like Wade said, this is a kind of a separate business you're in essence starting. You want this to have its own, almost its own accounting, if you will.
Hey, Kyle, I just want to add too that you're not going to pay interest on that money that's in that account too, like you would in one of your other accounts come tax time.
Interest or tax?
You're not going to get a 1099 INT on your money that you're using from your policy.
Correct. You will not get a 1099. Now, this will keep it so simple because you have one separate account where this is coming in. If one of these policy loans goes to like a normal business account and you forget about it, I am sure there are people out there that their CPAs they're not watching this as close as we are. So they might say, ooh, you must have got a bonus. We're going to call that income. And you could get taxed on that if we don't catch it. And so That's why I'd prefer to have a separate account where it's very easy for me to identify. Because then I can go back and check on One America's website. Hey, when did I take this policy loan? Back in January, and the amount was 17,587. Perfect. That matches up with this. That was a policy loan. We should not count that as income. But a lot of us, we're probably not thinking of it at that level just because there's a million things going on in life every single day.
But if you are keeping track of it, you'll know.
And
Yeah.
if it's separate from everything else, this would be no different than like we don't want to commingle our savings, our checking account, our business accounts. It's good to have some separation of those. Same thing with the policy loans. It's from an accounting perspective, it's just going to keep your life so simple, less room for errors if it's not all commingled into like my personal checking account. I mean, the amount of transactions we have with 4 kids now, I don't want policy loans commingled in there when we're spending money left and right, right? We're in baseball season. We have so many different things happening. If we throw now policy loans and loan repayments into that mix, it's just going to be hard to keep track of it. And it's going to make me I got to spend more time later dealing with it. So literally setting up a separate bank account is one of the first things we'd encourage everyone to do when they get their policies started. When you take your first policy loan, get that separate account set up, and then the accounting from there is so easy. You'll be playing the game like a pro, especially if this is like your first, second year in your policy.
Yeah.
So I think just to probably just bring some clarification to that, to answer your question, James, like this is not the money, the loan you get from the insurance company is a loan, just that. So you would not get a 1099 on that.
Yeah, no, I maybe didn't state it the way I intended, but I meant that when you're paying it back and when you're saving, I mean, I look at the loan repayment almost as a savings, right? And instead of putting it into another account where I would have to, where I would get interest at the end of the year, I'd get a 1099 INT. Well, instead of that, I'm putting it into PUAs and loan repayments. So I'm not,
Correct.
I don't have that. That was kind of my point.
Yep. Good point.
Mhm. And to solidify the point here is remember, Jane, that when you pay your premiums and you pay PUAs with the additional spread from your loans, all of this is going into a vehicle that treats the cash value as a tax deferred.
Right.
So therefore,
Yeah.
there's not going to be an annual accounting for tax purposes of 1099, for example. Yes, ma'am.
Yeah.
Absolutely.
And that's one of the things that I think is beautiful about it.
How do you mean? Just kidding. Thank you. I agree with you
Uh,
100%. I'm just kidding. I'm just
Didn't
kidding. I
want me to
totally
say it again. Okay.
I hear you, my dear. Thank you so much. Allison has a question, Kyle. She says, when you prepay a portion of your loan, you receive a prepaid interest refund applied to our principal. Let's talk about that.
Okay. Let's dive into that one, and maybe let's cover that one right after we go through the few different loan options, because I think that'll tie in perfectly. Before we do that, Josh, did you have a comment or a question you wanted to pose?
No, I was just going to kind of highlight what Jane was talking about, that I think she was basically saying, manage your segregated account in a way that if the money is going to be sitting there, that money will be taxed and you will get a 1099 on. So if you don't have immediate use for it, I think she was saying it's more efficient to keep it in your policy or pay back that policy loan, because that's what's not getting the 1099. But if you just leave it sit in that segregated account, that will. I think that's what she was getting at.
I love
That
it.
was my point. Thank you for articulating it better than I did.
I love it. And that goes back to perfectly our benefit of ultimate control. We just have more options with this financial tool. So let's go a little bit deeper now. When we kind of understand the flow of money. When we access a policy loan, it's coming from the insurance company's general portfolio. That's why your cash value continues to grow uninterrupted, because you're not using your own cash. It's coming from the insurance carrier. And it should go to a separate account. Now, let's just assume for quick, easy math, because I only have 8 credits at a community college, so we have to keep this simple. If we borrowed $10,000 from the insurance company at 5%, That's the loan interest rate. And we all understand that the insurance company has to charge an interest rate that would be higher than what they're paying on their policies. Does that all make sense? You would not believe some of the things that we hear online that my policy's earning 6 or 7% and I can borrow at 5. No business in the world could operate on those margins and stay in business for a decade. I mean, they would be out of business quite quickly, and we do not want that to happen with these insurance carriers. So we
Those are
basically have
called
three
Ponzi
options.
schemes.
Well, yes, that's a Jeff is in Utah, the greatest state that launches all the Ponzi schemes, right? No, I'm totally joking. Halfway joking. All right, so we got a few different options when we're going to take this policy loan. Option number one is we literally set up a traditional payback. Now, this can be actually pretty fun. When's the last time you bought a vehicle or a mortgage or, really anything that had a 5, 7, 9 year payback schedule, whatever it is? You literally get to pick what this is when you take these policy loans. So what I like to do is if I'm going to finance a vehicle for a family member, I'm going to try to keep it as close to how it would operate with a commercial bank. We're just doing it inside our family. So if it's a vehicle, we're probably going to go 60 months, 5 years. So in this case, if it's a 3-year payback schedule, we're going to pay back $3,596. That'll get it paid back in 3 years. That's what we would be paying annually to that. And the cool part is you literally get to set these terms. So if you want to extend it out, you could do 8 years. You could do 4 years. You could literally do whatever you want. There's no penalties to change how long you want the outstanding loan. Now, option two, one that I probably use most often, especially growing a business, I love this interest-only option. The ability to take a policy loan and I'm paying $500 per year in interest to use that money to grow my business. Now, that doesn't mean I don't ever pay it back. But if I want more cash flow for my business now, I'm going to take the interest only option, which, by the way, they don't ask you this. The loan you're getting is basically an interest only loan. You can just decide how much of the principal you want to pay back. Think about that for a minute. So in this case, I might say, you know what? I'm going to leave this money, David, Wade, $10,000, and I'm just going to keep rolling it in the business. We're doing good with it. I'm going to keep stacking. I'm going to keep rolling it, and I'm going to pay back that loan maybe in 4 years, and I'm paying a little bit of interest per year. And if we wanted to go even further, let's say an event happens like we talk about in our Tough Money curriculum. What if COVID comes along and it shuts my business down? We did not see this coming, and I can't even afford to pay the interest. I need every spare dollar to keep my business afloat or whatever it is. The third option would be basically you're going to defer the interest. You're going to let the interest, you don't even have to pay it out of pocket. You're going to let it stack onto the next year's loan amount. Now, the reason I put that one in red is because you got to be careful with doing that too many years in a row. We have seen people get in trouble abusing the flexibility and the control they had with these loans, just saying it'll be better next year. It'll be better next year. Next year's the year when we can start paying something back. And then an event like COVID comes around and it wipes them out because they were over leveraged. So you get to pick any different type, option 1, 2, or 3 with this, or anything in between. And so the ability to have that unstructured, flexible loan and repayment schedule, I honestly love this. It makes the money game so much more fun when you get to decide like exactly how you're going to pay this back. And last thing I'll talk about, and then I want to kick it back over to you two, Wade and David, is let's talk about this policy loan interest. So if we take this policy loan, $10,000 at 5%, we know full 12 months, leave that loan outstanding for 12 months. We know this is the amount, $500 is what we would pay. But if you're paying back the loan every single month and you actually pay it off the entire loan, like in month 6, you would not owe $500 in interest. You would have paid probably closer to $250 of interest at that time, because they're only calculating this on how long did you actually have the loan outstanding. So if I took this loan at 5% and I paid it back in 6 months, my effective interest rate is going to be closer to like 2.5% if I only had it outstanding for 6 months. That's probably not the exact perfect math, but if you have money lying around, like Jane was saying, and you want to make additional principal payments towards that loan and reduce the 5% down, it's a pretty good deal for you to do that. And it just opens up the line of credit so you can use it immediately again. So let me stop right there. Let's take any questions. And then let's jump back into some of the visuals I think you and Wade have, David.
I had the same question Allison just put in the chat about PUA versus paying loan back. Well, it looks like Josh answered it.
So I think I'll probably just add a little bit of context is like, there, obviously I always said there's a hierarchy to where payment should go. And this is Wade's criteria. This Kyle might have a different criteria. David might have different. Jane, you might have different criteria, but this is my criteria. I always say, if I had, so many dollars and it has to go to the policy, where does it go? I go to pay the premium. You have to pay your premium in order for your policy to grow. Then I like to max out my PUAs because I want the death benefit that those PUAs will generate. Because if you buy a dollar into PUAs, it buys $3 worth of additional death benefit. So I like that leverage. And then I would go to paying the policy, the loan principal at that time. So I guess that's how I would probably do it. But some people might say, nope, if I have a dollar, it's going to be the loan first. And there's nothing wrong with that. But that's just, again, is my criteria. And I've been doing these for a number of years. So I thought over the years, that's kind of how I see the best flow of my dollars. And again, because it fits who I am. That's the beauty of policy loans, is that you can structure it the way you want it to be structured, the paybacks and where those dollars go.
I love that, Wade. And we have a video. I'm gonna grab it, David, as soon as I kick it back over to you, and I'll put it in the chat because we definitely explain that and the long-term benefits of maxing out and paying more paid up additions rider, which has a very positive impact on policy growth over time. I'm in that same camp as Wade. I'm going to try to pay as much base premium and PUA as I possibly can, and then I will go after loan interest and principal. But, and this is a big but, it all depends on kind of what's happening in your financial life.
Yeah.
Sometimes the best thing you can do is refill that liquidity and just get that loan chipped away at. I have seen people try to get too aggressive too quickly, and then when events happen and their financial world shifts, they're not in as tough of a position as they could have been. So I would just say, to Wade's point, I agree 100%. But there are going to be circumstances in life where you probably want to, as aggressively as you can, refill those policy loans.
Yeah.
Whether it's a windfall, the sale of a business, or just a typical amortization schedule. I love paying premium. It's the only way to make your policy more efficient in the future. But there are going to be times where paying down that loan is the greatest thing that you can do.
Yeah. I'll take the opposite side of the trade just to offer fairness here. I've been in the situation where I've used my policy loans to create transitions in my life from employment to business or to float myself through a period of, when you have kids and you think you're saving a lot of money and then you have kids and you're not saving that same amount of money kind of situation. That happened to me now twice, fool me once. The reality is that, although I love the idea of maximizing my PUAs, I've started to favor covering some of my loans to replenish my cash values because in my assessment of what's happening in the economy is really valuable for me to have some dry powder, to have the ability to borrow that money. And although I want to continue to pay PUAs, I have that opportunity into the future, and I've shifted my perception in different times to increase or replenish my liquidity. There's no right or wrong. The clarity needs to be on what are the rules to exercise our discernment. If we understand that premiums is the only thing that creates growth in the policy and growth in the cash values, and that's what you want to prioritize, wonderful. It's going to increase your death benefit, your cash values. If managing the loans not only brings you peace of mind, but the proper relationship and responsible management of the policies, for a period of time, there's nothing wrong with that, and you will be replenishing the ability to have liquidity. So no right or wrong. Discernment, I think, is what we're trying to uh, communicate to all of you. But I do like that standard. We sound like lawyers recently, but it depends. But typically, the hierarchy, like Josh put in the chat, if you didn't see it, base, PUAs, paying the loan interest to avoid that compounding or capitalization of the interest in the principal. I'm going to give you this in a different visual, just in case you're a visual learner. If you forgive me sharing with you one more slide, hopefully you're not tired of this and my slides here, but if you want a visual representation of this, let me give you a curve that will probably help you understand this. I think unstructured loans are a function of two things, which is what policy loans are. The ability to have more flexibility in the x-axis with the need for better management of that risk as you go out into the flexibility space. So if we go back to the three examples or three options that Kyle gave us, option one, I'm going to amortize this loan and I'm going to be the loan officer. The only part that the insurance company control is the interest rate on the loan. Why? They need to replace the yield they would have earned otherwise with that money. They're giving it to me before they buy a corporate bond. So I'm going to replace what they would have earned in their portfolio. Other than that, like Kyle was saying, I can take 3 years, 5 years, 10 years to amortize this. I can skip a payment. I can wait 90 days to start making the pay. I can set up auto pay. The flexibility here, it's already incredible because I'm the loan officer. But this would be option one, amortized loans that include an amount of principal and interest. If I need to keep pushing down the flexibility line here, I may say for a while, Kyle, I'm going to borrow $100,000 to put marketing dollars in my business. I'm going to give myself a couple of years to have that principal out. And all I'm going to do is make my interest payments at anniversary so I don't compound the interest. So I'm going to treat this as an interest-only loan for X amount of years, more flexible now, right? The further you go is your option three, Kyle, capitalized interest. Kyle, I don't know what's going to happen to this investment property, but I'm going to buy this house. I'm going to hold it for 5 years. And eventually I think I'm going to sell it with a multiple. And then when I have that windfall, I will repay that loan. I'm not going to make any interest payments or principal interest. More and more and more flexibility is going to require having a plan that is more thoughtful with a certain criteria, which I'm about to show you here in a second, but I'll put this for you just as a thought. The more flexibility you introduce with these loans, without the proper education, understanding, and plan to manage the risk, you enter the danger zone. And a lot of us have flirted with this, and it's very uncomfortable, by the way. So please take us up on the offer of educate yourself. I'm glad that you're all here. Look at the video that Kyle is going to put in the chat. We have a couple other videos in there to truly understand the power of this flexibility and the responsibility that's required to manage it. I think if you understand what we're talking about and the criteria we're going to discuss, you'll see that staying in the safe zone is a function of understanding when we access this debt, how we do it, and why the source of it is so important, Kyle. So let's visit. Oh, sorry, wait, you were going to say something.
Yeah, just give us a quick example of what you're talking about with, how did we end up like in that dark red zone? Just for example.
So these are, for example, the individuals that reach out to our company and say, hey, can you guys help me get a max loan? I want to borrow everything that's available. I have $100,000 and I would like the max loan. And we start asking questions. Hey, how do you plan to replenish that money? Well, I don't have a plan. And what do you think is the timeline you're going to use for them? What's the purpose of the loan? Well, I'm going to go buy a truck that I really love and I just want to use the money. I want to use my own money to buy that truck. The language people use, the lack of education, the lack of understanding, the lack of planning for it likely leads people down a path where just because the form asks two questions, how much money you want and where do you want to deposit, doesn't mean that we have the proper management for being good stewards of that ability to have an unstructured loan rate. That would be probably a max loan with no education and I have no plan. It's always a red flag for me.
Thank you, David. Now let's flip it on our head real quick. What would be like a safe zone loan? I was thinking about that cash flow tracker that Joe put together for us.
Yeah.
But we understand what our burn rate is. We have so many days of safety and security that's non-negotiable in our lives, right? And so I'll let you probably go into that. That's probably what you're going to hit next.
Well, I wanted to propose, to answer your question, three questions for everyone, right? Like, when would I know that I'm on the safe zone? And I think it's the people that can confidently answer the following questions. When will you use that? Kyle, when will you use a policy loan typically?
Yeah, if we're thinking like bankers, it's only when there's a high chance that the money's going to come back, like you said earlier, David, with friends. So in this way, we'd say it's got to be a profitable opportunity with a high level of certainty. I think the more certainty I have and the more profitable it's going to be, bingo. Use policy loans for those reasons. Give yourself 5 or 10 years, and you're going to see your entire financial life change.
Yeah. Yeah. Like people that know and understand what they're doing, that they understand, they've underwritten what they're about to do and say, I can borrow money at 5 because I'm very certain that I can make 6, 7, 8, 9, 10%, and I'm going to capture a spread. It's a profitable endeavor, right? So,
And and the opposite statement and the scary stuff we hear, and this is stuff that I used to teach, 10 years ago too, before I met Wade, and Wade really educated me on some of the things that, we were teaching that were not full truths. Like, we're seeing it right now. I bought my daughter jewelry with a policy loan, and I'm making money buying jewelry. And we're like, well, yeah, that's not really the case here. What you did is you added a 5% loan interest rate to jewelry you probably should have paid for with actual cash. And so if you think about it, the banker's mindset is we're only going to lend when it's a really good opportunity for us to lend. Now, that comes with some caveats, right? It doesn't mean you can't use policy loans to, like David was saying, transition. If you're going from career A to career B or whatever it is, it's you can definitely use these policy loans for whatever you want, but we need to be careful that we're not thinking we're taking a vacation to Bora Bora with a $15,000 policy loan and we're making money taking that trip. I can assure you, you're losing money. You're gaining valuable experiences, and that is worth a ton, but we are not getting wealthier taking vacations with policy loans.
yeah. If we're not buying an asset, we are the asset. And all we're doing is forcing ourselves to save from future income to capitalize the bank back by saving ourselves, covering that interest, and hopefully even paying more to pay additional PUA and cap. We are applying the banking principles to how we finance liabilities. But let's be clear, some of these things are liabilities, a car, a vacation, and it is okay to use our banking system. All we're saying and suggesting is that hopefully when you decide to use this debt, you're making it a profitable endeavor, whether the asset creates a profit or you create the profit. Fair? Okay.
That's it.
Question 2. How much debt will you use, Kyle?
This is completely going to change from person to person. We see clients that we work with that love to have 90 days of liquidity. So, or 6 months. We have clients that are some of the best investors I've ever known that have literally 5,000 days of liquidity. And this is just personal choice. What has your life experiences led to you at this point in your life? That'll it needs to be consistent with your liquidity reserves.
Yeah.
And we have worksheets in our Tough Money curriculum that will help you identify like when is enough when it comes to your liquidity reserves. Everyone's calculation's different.
Yeah. So the tool that you were referenced there is like if you have $500,000, what does that mean to you? And it depends. It depends on your financial life. So if you burn $100,000 a year and you want to have a year of reserves, the first $100,000 out of that $500,000 should be money to keep in liquid safe assets to protect your family and to take advantage of opportunity. The rest of the money, the other $400,000, may become investable capital that you can borrow against. But now you have a clear criteria of how much is enough to protect you and how much is enough to go pursue opportunity. This is not a right or wrong. This is you look at yourself and your spouse or your business partner and say, we should never borrow more than 70% of our cash values, 80, because we would like to keep 10, 30, 40% in reserves to protect us at all time. Is that thought there? And finally, which is the theme of today, is what environments will you use to source your debt? And on regards to this, hopefully we've been making the point, environments that maximize your control, your flexibility, and your certainty. The idea around this is that life insurance likely is a source of debt that is unmatched in terms of the ability to have control, flexibility, and certainty. And to illustrate that last point, this will be the last chart I have here. Wade, this is borrowed from an article that you wrote, making comparisons for different criteria of the common way people source debt versus the uncommon ways. If you want to take a screenshot of this, just to be considering, how do I think about all these things these guys have been talking about today? Wade, do you want to comment on this one?
Yeah, I mean, again, how we think is Nelson talked about that in his book, right? Everything revolves around how you think, and the common person thinks that they have one place to go when they need money, and when you have one source one place to source your debt, you don't have options. You need multiple places, and sometimes I will go to a bank and take a loan if it suits me and if it's purposeful to me or if it makes sense to me. But I also have another option where I can go to borrow against my policies, go to my insurance carrier and say, hey, I want to borrow against my policies. And then that puts you in control, because that's really the whole conversation is, where are you having control? Are you in control when the bank gives you a thumbs up or thumbs down if you want to expand your business? No, you're not in control. If I go to my insurance carrier, they say, hey, how much and to what address? As long as you have enough cash value in your policy to borrow against, that's all they ask, and that's the important part of that conversation. Acquired for approval. Again, the process of taking a loan. I think sometimes we get fooled and say we can get it in a day, we can get it in 2 days. I have, but I'll tell you that's the exception. We should plan on, let's be reasonable business people and say, if we think we're having an expense, 7 to 10 days is probably pretty reasonable. I think we should get the money in 7 to 10 days. If there's an emergency, we need it quick, and we've had a couple of those, and it saved a couple of our clients some big dollars and some properties and some different opportunities. Let's take advantage of it, but let's not make that the norm. Because again, insurance companies are not banks. They're not transactional banks, and thank God they're not.
Yeah.
So let's give them that grace to understand that they're not designed to move money on an hourly basis. But banks have become a lot more difficult to move money as well. So don't hold them up on a pedestal. And again, the repayment terms, you make those up. The privacy part of it never hits your FICO score. Think about that for a second. It doesn't hit your FICO score. It's like it's a private transaction, and that's huge. So, and again, I'm gonna probably just hop back up here. The repayment terms are big from the standpoint of, people will ask me, what do you pay your loans back at? And in my family banking system, we pay back at 10%. We do everything at 10%. Why 10%? There's no magic there. I'm just not real bright sometimes, and so 10% seems to make sense. And so interest rates go up, interest rates go down. I just do 10%. But they say, well, if you're borrowing from the insurance company at 5 or 4.75, why are you paying 10%? We have to love our families and our businesses more than we love Wells Fargo.
Yeah.
We have to love our business and ourselves and our family more than we love Wells Fargo. So treat them better than you treat Wells Fargo. So I'll let you finish it out, David. I'll let you take it home.
I was just going to say, we are at the top of the hour. We want to be respectful of your time. We will stay here longer if you have questions, and we'll continue the conversation if any of you wants to stay. But we want to thank you for being here with us. We will be here next month, bringing more education to our entire community. So we hope to see you here. I will end up with a thought, and I'm going to read 2 comments here. If you want to put any other questions, I'll be happy to read them. We'll stay here longer, but I tell all my clients following. When you think about that, think about the following question. Who is the loan officer making this decision to approve and control the terms of the debt you're sourcing? And if the answer is not you, somebody else is controlling those terms, which puts you in probably a different position compared to if you are the person making those decisions and giving you more control, flexibility, and in general, the ability to manage the risk and the ability to make yourself stronger. Which is why we propose that policy loans are an incredible source. All of this is possible because the flexible loan provision provides you with a guaranteed line of credit of an unstructured loan. And I'll tell you, the only bad thing is that likely you wish there were more zeros to the right on the cash value available to you to borrow against, regardless of how much cash value you have. So with that, I want to thank you all. I'm going to read the comments. If you have to go, we wish you a blessed night, and we look forward to seeing you in May.
David,
please go ahead.
I would just make one comment about, to your comment. Who's your loan officer? My wife is my loan officer.
Well,
So-
that is a different conversation, way more. And let's not go there right now. It's too late.
So
Okay,
you talk about a tough one to handle. You have to like, okay, so let's make
talk
it good.
about, sorry to interrupt. Let's talk about living in a community property state where your wife has to sign the approval form to make the policy loans real. Me
Yeah.
and Kyle here in Arizona. Okay. Mr. Crater says, at the end of the day, all loans have to get paid back. Either you're paying them back now or they're paying back when you graduate. I'm going to upgrade the language on your statement, Ken. I'm going to say that all policy loans get paid for a fact. That's the only way we can have an unstructured loan. The insurance company has a guarantee way of making themselves whole by either lending money against collateral, they control, guarantee, basically they're the custodians of it, and also like you said, when we pass away, if we have a loan outstanding, the death benefit will be made net out of that loan balance. So you are correct, my friend. Thank you for sharing that. Mr. Wes says, taking out bad debt, only investing in things you understand, stacking notes with people you know and trust, hopefully understanding and practicing IBC themselves. All this while keeping a healthy amount of liquidity. I love the summary of your thoughts there. Wes, sounds to me that this call was very valuable to you and you had very similar takeaways that I have. So I love that you shared that. I appreciate you, my friend. Thank you for being here. Have a blessed night. Brian Fleming, unless the loan you took over was 16.99%. Sorry if I missed the joke there. I'm out of time, Brian, but thank you for being here. Jane, thank you for being here. Wes, yes, sir. Dwayne Burnell, Mr. Dwayne, thank you for being here, sir. Great presentation, correct language describing loans means a lot coming from you. Grateful that you're here, sir. Pleasure to meet you, by the way. Look up to you, and you've been a great influence in my life, so thank you so much. Very educational. Thank you, Tom. Wes says, this was great, fellas. Thank you so much. Thank you, Wes. Don't have any other Tina, thank you for being here. Allison, thank you for your comments and questions. Any other outstanding questions, comments?
Hey, David, while we're waiting for those to populate there, if there is something, I want to address something I've heard a number of different times. People say, well, if this is so great, why isn't everybody else doing it? Or if this is so great, why am I just hearing about it? Preparing for this class, I went through some material I wrote probably 6 years ago. And in that research, there was the first policy loan. The first policy loan made was in 1948. Or excuse me, 1848. 1848 was when the first policy loan was made. So think about that for a second. So people, just because you haven't heard about it doesn't mean it's not being advertised. There's not insurance companies on the street corner talking about policy loans. It's just a provision of your policy. It's a non-forfeiture provision of your policy. In 1922, the head of Equitable at the time, he wrote an article. He wrote just a short article talking about why people were taking policy loans, and it's pretty interesting why they were taking loans against their policies. He says these reasons include to pay premiums, to purchase supplies, equipment, food, and clothing, to pay outstanding accounts, to merchants for professional services, to pay rent on farms, and to invest the loans for proceeds over profit. So in other words, it was a bit of arbitrage. But that was in 1922 that he wrote that piece. Policy or loans have been around a long, long time. So don't, just because you haven't heard about it or you haven't been doing it, it's something that's been in the works for a long time, and it's carried businesses and it's carried people through very tough times.
Yeah, you and I have talked about this before, but it's fascinating to look at, the wisdom of our great grandparents. Some of the environments in which our great grandparents used to save included, and primarily in addition to banks, included life insurance companies. And, one of the key sources of liquidity during the Great Depression was people accessing, when banks shut down, was accessing cash value through the loan provision of their policies. But Wall Street has become very, very influential and very good at shifting that dynamic and taking people away from using private contracts to store their liquid and safe assets, and using now, all the way to retirement planning and all these modern products, shifting the location of those dollars for them to have control and benefit and profit and receive income from. Think about the fact that there's $40 trillion sitting in qualified plans today, 100 years later. It's fascinating to think about that. So it's definitely been around, and it's not a new asset. And I would almost, we talk about this all the time. Think about an example of a company that has been profitable consecutive for 100 years in the American economy. And you will not find in that list anyone except mutual insurance companies today. So fascinating to think about. Thank you, Wade. Kyle, one for you here, if you don't mind. Allison says, would you advocate taking annual expenses out of our policy loans and use our income to pay PUAs and loan repayments? When you have excess money, you need a new policy, correct? So 2 questions. Do we treat this as a annual expense financing? And when we have more money, we're too rich, we take a new policy.
Yeah, I put our 4 stages of whole life insurance ownership in the chat, Allison. I think that one will help with it. Here's kind of my thoughts on this one. It all depends on what your goals are. I was mentored by guys that were doing that owned successful businesses, and they were taking out large policy loans quarterly to pay all the business expenses, and then with the business profits, which were always higher than the expenses every quarter, they were replenishing the policies and doing this on like a quarterly basis. Now, it can be a very effective way to get tons of additional premium into policies. Now, I will say you want to be careful. I think we can make the argument all day long that it would be just as efficient, if not much more efficient, to get, let's say, 30% of your income going to whole life, using it to get your liquidity buffer built up, and just using the policy loans to make actual investments into things that kick off new cash flow to you. You're probably better off with option 2 than to finance things like groceries and annual expenses. Now, philosophically, I love the idea of doing that. I'm a big proponent of getting as much of my income into premium as possible. And I will say that, like, doing this now over a decade, the policies that I've had that are 11, 12 years old now are so efficient, it would be possible for me to start doing things like that just because the growth is so aggressive. Whereas when I was in the first 5 years of owning whole life insurance, I definitely could not participate in a strategy that advanced. So I think that one would definitely take a one-on-one conversation on let's figure out what you're trying to accomplish. And if we could find you a way to do that with less time, less risk, and less money out of pocket, we should probably take that route all day long. And that idea does get floated around. It's basically page 48 of Nelson's book and page 25. We should finance everything in life. I love the idea that the technical aspect of it is a little bit more difficult.
Yeah. If I may add just one more thought for you, I believe that was Allison. If you go to page 35 of Becoming Your Own Banker, Nelson outlines, and I've missed this a million times that I've read this book, and it's now landing in front of me like a ton of bricks, is the most common mistakes. He outlines the most common mistakes of implementing infinite banking. The individual does not make a way of life, number 1. Kyle is talking about a system that he's made a way of life for 12 years and more. So he's talking with a level of conviction into the future for most of us. Number 2, most managers most individuals trying to implement this too fast. I think that there's a lot of people that try to do, how can I put all my income in year 1? There's some challenges from that because there may be a reason why Nelson set the expectation to do this. It might take most people more than 15 years to accomplish this. It's a lifetime. It's a way of life. The boss lacks conviction, managers fuss too much, training gets short-shifted. To do this without the proper education becomes more of a danger zone than a safe zone. So I highly encourage you to be patient. If this is a way of life and it's called whole life for a reason, not 24 month life, there's a reason, and the level of maturity you'll have as you progress with education and implementation will surprise you when you look back in hindsight. So absolutely. Appreciate that insight, Kyle. Second question really quick for you, or Wade, really quickly. Hey, I have excess money and now my policy cannot receive more premiums. Should I consider opening a second policy? When do I consider opening a second policy of myself or somebody else that I have an insurable interested in?
Yeah, I think there's a couple things there. Number one, how certain are you that future income is going to keep going up? Like that's a very, very high level certainty. I would feel comfortable adding on additional policies if I know my income is increasing rapidly. The other one is as long as my liquidity reserves, I'm past that limit and it's very healthy, I might think about starting another policy there. But I would not want to interrupt my liquidity ratios and then put myself in a danger zone to start on additional policies. So I think there's a couple things going on there. Do we have the income to support it in the future? And does it stay consistent with our liquidity reserves, which is a control conversation? If we're green lights on both of those, oh yeah. I mean, I was buying 2 to 3 policies every year for almost a decade because we were in those categories. And so, I love the idea of adding on policies. As soon as you're pushing that first one to the limits and you have next year's premium ready to go, your liquidity's rocking and rolling, I would add on to that system and start the next branch office, if you will.
And here's something to think about too, as long as we're kind of on that same topic. Are we designing our policies? Are, the person that invited you to this meeting, and are we having the conversation with our agent? Because again, we're here to empower you. We're not here to do for you. So it's an empowerment conversation. But thinking today, are we building and are we planning for success? How are we having the conversation? And so instead of like taking a look at today's snapshot and saying, let's build a policy for today because I got an extra $30,000 in income that's got to go somewhere. That's great. Now this is the third time you've done it. Maybe we should think about, well, how do we? You're obviously successful, kind of exactly what you're saying, Kyle. Let's build this so we can build on success. We're not constantly having to start over.
Yeah. I will say this as an agent myself, and I want you to consider this. You may be sitting in front of an agent thinking, how do I put the max liquidity on this so I can make this and that move in the next 12 months, 24 months? When you're talking to one of our team members, we are thinking, what is this person going to need in the next 12 months to support their goals? And what is going to happen when they experience growth in the next 5 years? And what are they going to need, perhaps a passive income time or retirement if that's your objective? I may be the person giving your wife or husband a hug the day you pass and knocking on your door and bringing a check. For us, the horizon is much longer because what we're building is a relationship, not a transaction. We're not trying to sell you a piece of paper. And with that in mind, the ability to meet your goals in the short term, but also create the capacity Wade is talking about, and the ability to use this asset in a meaningful way throughout the rest of your life is our objective so we can be part of your wealth team for a long time. That's how we all feel about success in our businesses, being in your kitchen and having conversations with the next generation about what you started, hopefully 10, 15 years in the past. So with that, I don't see any more questions, and I'm concerned about Wade's loan officer getting upset. So I am going to suggest we end the call here. We again want to thank you for being with us. We feel grateful to have the opportunity to fulfill our purpose by serving you, and we look forward to seeing you in May. Have a blessed evening, everyone. Thank you so much.
Thank you, everyone, for joining us.
Thank you.
Thank you.
As always.